Still no AC there?
What's up, everybody? This is Sang Lucci TV. We are live here. You are with Lucci and Brian Weiner, aka Ween, in the pitch rating back in the day. I don't know if you can hear the storm over here. How's it looking over there, Brian, with this storm, buddy?
It's sunny now. We're good.
It's sunny.
Yeah, it's gonna crush you. There might be hail for a good 5-10.
Yeah.
Now we're good. So have fun.
All right. Sounds good. What's going on over there at the office today, man?
I almost broke my desk earlier because trying to get a test tray going
Yo, let me
tomorrow.
see that shirt, man. Let me see that shirt. What's up in Massachusetts, baby?
Fucking represent, baby, all the way.
Invented America. You see that? Y'all see that? Massachusetts, baby.
Yesterday and today, every day.
All right, so dude, I was I was bitching. I was just bitching on Twitter about the comments from Indira Nooyi, man. I don't know if you heard. This was the Pepsi CEO.
No.
She made comments about women needing to handle a job and all that kind of stuff. Anyways, I'm a little backdated here. So
Yeah.
Brian and I are going to talk today about market making, and one thing I wanted to ask you,
Hmm.
and this is what I wanted to get sort of a theory on from you,
Yeah.
was that, let's say you see an informed move happening, right? So I want to take an example of, some of those high flyers that we've been watching, the
Yeah.
Netflix and the Tesla. So
Yeah.
you take a look at the Tesla this morning, and I'm going to pop up a chart here.
All right.
I want to know that some of the things that a market maker is able to do, or what are the things that he's doing when there's sort of an informed move happening in the stock. How are they still making money during that informed move, or
Yeah.
are they just stomaching the hit until better times come around for them?
Yeah, I mean, no, I mean, most market makers are hedging their delta at least, which is the most sensitive thing. You got basically they are calculating most likely a intraday realized volatility, which is going to basically inform them that we're continuing to move, right? All
Right.
right. So they're going to widen out a little bit. So even if you go and reach to buy, like especially you go and reach to buy some
Right.
puts, you're buying them at a higher price, like maybe 30 cents higher than their theoretical value.
Right.
And the as we're going down, there's buyers coming in to buy that and catch that knife, and so
Right.
that's when they come in and smack it down. So they're the ones that are actually providing the liquidity for buyers. They're smacking it down, so
Okay.
that's how they get their hedge off. They're also affecting parts of their curve to take off delta. They might be offering calls more on the way down. They might be asymmetric with their bid and ask around 40 delta calls and higher, so they can take off some of their delta by selling calls to
Okay.
people. Maybe people want to buy a call and hedge it. Other people have different protocols. So they're
Cool.
just skewing their market.
Cool. So what I wanted to do, I want you to take a look at this chart right here. So you see the chart that I popped up, right? This is a Tesla 222 and a half put for today.
Yeah.
So I kind of want to just visualize this for people
All right.
and be like, okay, if I'm sitting here buying this option, for example, right? Let's say it's
Yeah.
me, like me, man. So let's say I'm buying this thing, two and a half, $3. Let's say I'm aggressively hitting the offer.
Yeah.
So
All
you're
right.
saying as they're selling the contracts to me,
Yeah.
they're also shorting the stock, correct?
Yeah. They're definitely short in the stock.
Okay, okay.
They're.
And
Yeah.
and then what are some of the other things that they're able to do to, let's say, stomach, obviously them losing money. So obviously they're hedging in the stock, and that's helping them out a little bit. But are there any other tricks that they use to know that an informed move is coming? That way they can pull back on their spreads or their liquidity, or
Well, yeah.
do they do shit like that?
Well, yeah. Okay. So you got a couple things. For like I was saying, the realized vol. They're measuring how quickly the stock's dumping, and that's going to affect their bid and ask. They're going to widen out. They're going to lean towards buying puts and selling calls. Um, Also, they have tentacles out in other strikes. That's not the only strike that they're dealing with. They're dealing with other strikes, and so you have one informed buyer of an option, then they're going to affect the rest of their curve in that month, and not only that month, they're going to do it in other months. So there might be they're going to affect their curve in other months as well, and there might be people that kind of want to participate in another month, not even realizing how much those market makers need to get short delta somehow.
Okay.
So they're running into other small market makers, professional guys or whatever,
Yeah.
and they're affecting their bid and asks with. So I mean, again, so that first buy that you made, and it was
Yeah.
very, you had a good instinct. They're fucked on that, most likely. They're not perfect.
Okay, okay. So there, what you're saying is like they do have to stomach. So in other words, there are periods in time where guys like myself are sort of taking over the alpha there, and
Right.
they're just stomaching and just waiting it out until they find. How do they know? I mean, how do they know? How are they able to anticipate so much faster than we are where the turn is? What are those kind of things where they can look at something and be able to see like, okay, now's where we're going to come back in and start selling a lot more options. You know what I
Right.
mean? Like now's where we're going to come back in and start selling all this shit. You
Right.
know? How are they
Yeah.
so confident when they make that move, when they make that turn?
Well, again, like the tentacle thing, like they're feeling different strikes where there's different people coming in, and they either might feel a big, large order, like say on the bottom, which was like right before 11 o'clock, the bottom in Tesla, the spike in the first spike,
Right.
um, you know, they're feeling other people coming in all at once, so they kind of have um, a delta feel for the pressure, a delta pressure, what orders are coming in. A lot of professionals and different strikes are coming in at the same time on puts. So, but at the same time, they're kind of cost averaging. They're not perfectly hedging the whole
Right. Right.
way down and the whole way up on
Right.
that put.
Right, they're
So
cost averaging because again they have to provide the liquidity for
yeah,
the move, right? So
right.
they're selling 3.5, 4, 4.5, 5, all the way up to 6.
But not only that, I mean, they're hedging probably 80% of it, but they're also, the vol is actually coming up as we're dumping. So they're cost averaging their vol because their exposure isn't just in delta, it's also exposure in volatility in the vega, it's also exposure in the gamma. So there's things of that. So we'll just say vega is the only other exposure. When that put is spiking,
Right.
the volatility is probably coming up a little bit too. So they're selling more and more. So they're selling at really good prices in terms of volatility as well. You know,
Okay.
and and if it keeps going down, 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 say it didn't stop there, it kept going down,
Right.
the stock, then they're going to have to maybe they might have to push the stock a little bit more to flatten out their delta. I mean, they can
Ah,
hold a reservoir of delta, but it comes a certain point where the guy that's running that, he has an alert, and he's like, we're keep moving, flatten your delta out, start getting short, take
right.
exposure that way. Let's check the news. All
So
of a sudden,
here's
the guy has to check the news.
all right, so here's the next question. So
Yeah,
now at this point, they have a inventory where they've written a lot of contracts
right.
and they're also short the stock. What happens now on the turn? You know what I'm saying? So do they sit there and try to go for these dips? Are they the ones buying back the contracts down here? Are they the ones buying back the contracts down here?
Uh,
From other folks who are still looking for that move to happen?
they're not forcing anything. They're
Okay.
not forcing that. They're sitting waiting. They're waiting for you to panic sell, like as we're rebounding, and someone's like, "Fine, I'll take my fucking profit. It's not as much as
Right.
I want," and they just sell it to you, and they're like, "Cool," because they're trading so many other products.
Right.
There's I'm not so many other strikes.
Right.
They just take an inventory. That might be just like 1/15th, 1/20th of their
Right.
entire inventory. They might not
Their whole
care.
book. Right.
Yeah, you
Right.
really realizing just one thing. They have so many other strikes and different months. And then also, if it's like an alpha move, the entire tech space is moving at the same clip.
Right.
They actually trade that versus something else. Tesla guy he might have Tesla and he also has Netflix in the same ship. So he's kind of hedging one versus the other in terms of like a long elongated move. And that's what actually I'm going to do also.
Right. Right. So now you also had a sort of automation background when you work with Heim at Trading Machines. So, I'm sure you kind of, you kind of experienced that world as well. What are the things that they automate to do this faster and do this quicker? Like I'm assuming here that these market makers are basically algorithms here that just adjust their bid and ask and sit there and they look at their book and say, okay, we're going to do this and we're going to do that. Do you know of some of the things that they automate to be able to allow them to help them do their jobs better?
Yeah, I mean, so basically, It's a weird situation because you have market makers that kind of join the other market makers and they fit their curve based on the market makers, and there might be, you got the DMM, the designated market maker, and he kind of has to have his own confident model, and he's willing to catch the bid in something that's getting dumped, maybe the vol's getting dumped or whatever. He's going to come in and he's going to buy it and he's going to hold it up. So he's the guy that really everyone, and he's the biggest guy out there. So he's going to kind of make the market more stable.
Okay.
And there's a benefit to that because he's the one that's there when no one else is there, and he's actually buying the low in the vol. So what I'm getting at is that
Right.
aside from him, everyone else is just joining, and they're market makers too. They're able to have algorithms that just say widen out. If there's a realized fall move, if we're really continuing to dump, they automatically widen out.
Right.
If there's big paper, they'll widen out, and they get to, it basically one button allows them to do this. They don't have to cancel all their orders.
Right. Right.
It's just
right.
like boom, I'm wide.
Right, right. And guys, everybody who's watching that's a little bit, that doesn't understand some of the terminology that Brian is using. When he's saying big paper, let's say somebody like myself comes in and says, yo, I want to buy, 200 contracts, 300 contracts or something like that. They'll widen out that spread. When he says widen out, he's talking about the bid and ask spread. So let's say the spread was usually 20 cents. They might spread out to like 50 cents or a dollar even. Brian, there's legalities though there, right? As far as how much spread or how wide a spread a market maker can post, right?
Yep, there are. So normal business hours, you have to be within a certain range, certain width, and you have to be at the MBBO certain percentage of the time. Okay, so they know how many orders that you have. They know what stocks you're market making. You have to be best bid and best offer certain percentage of the time, unless the SIBO says, because say the morning after Google earnings, you can be twice as wide. So there's certain widths that they have to stand by, and there's also emergency widths, like if it's a special event that they can widen out. And
Emergency width. Like, dude, is there any actual what is it, policing of this shit? Like, have you ever heard of a market maker getting busted because his spreads are too wide, dude?
I mean, I haven't heard of a specific one, but there are violations that people get. They get kicked out of you can't be a market maker anymore.
You can't be a market maker. Is it like a couple violations and then bam, you out, or
something like that? It's something like that. I mean, you can't just habitually be like pulling because you get hit on a 15 lot.
Right.
You shouldn't be a market maker then.
That was actually my next question. Like, I go for that big alpha, right? When there's like a big volatility, or there's just a big informed move about to take place in a particular stock. Like you saw that Amazon, right? From 325 to whatever, 350.
Yeah, man.
30 points in a couple of days. Like, I want to be in that situation.
Yeah.
I want to know from you, like, obviously market makers have to provide that liquidity. So obviously, whoa.
Oh, dude, you're going to die, son. Watch out.
Oh, dude, that was Saruman from Lord of the Rings, man. He's trying to tell me something right there. He's casting spells right now in the sky. Anyways, so market makers obviously are adding to that push, that 30-point push, because they're also selling the calls to us.
Yeah, yep.
But are they getting, like, smoked? I mean, I want to know that these guys are getting fucking smoked by providing that liquidity to me. And if no, why not? I mean, why not? Doesn't it make because they are hedging, right? They are hedging.
Now, you know how the vol goes up?
Yeah.
Like all of a sudden, okay, vol's going up because the first trade sucks, and they have another sucky trade, and then they realize, the guy that's running at Amazon, he might know, say he didn't know in the morning that there was the drone thing that happened, whatever. He finds out when he sees his red alert, it's like, you're getting fucked in Amazon. He's like, oh shit, drones. And so then he goes and he raises the vol, so basically he's sweeping. So the vol started right here, and it gets fucked up here, and he's like losing 30 grand. He's like, I gotta check the news. Drones. Right. He's like, I'm sweeping everything else. So he's also pushing the market too.
So he's playing it too.
Yeah, and here's the deal, man. Also, besides being short those calls, right, and you're getting fucked on that, he's hedging. He's also buying puts and hedging those. And what that does in the front month is that, say you hedge a 30 delta put, and we rip like $5. He hedges it perfectly. Now it's like a 10 delta put. He's making money on the gamma, so he's making money in other ways
Uh-huh.
by
Okay.
hedging puts. That's
Okay.
what gamma really does for you. So it's
Okay.
that the other world of actual volatility trading.
All right. All right. Well, dude, these are always like the most interesting conversations when me and you get together and just shoot the shit. I mean, what you got over there? You got Miller Lite or you got that Brooklyn shit?
I got some. No, this is like fucking high life, bro. This is Georgetown, fucking 99, right there. I gotta
All
wind
right.
down.
Anything you want to throw out here in this convo here
Oh,
before we wrap it up? What do you want to do?
I want to be fucking. I wish I was trading because Netflix. Some guy was trying to sell
Uh-huh.
some puts on the bottom of the day. So we're talking about market maker inventory.
Right.
Sometimes like on the if we look at Netflix on the dip of the day,
Right.
um, some guy was a little early, but he sold some 55 delta puts. He sold the four half puts,
Okay.
and they were like, I haven't seen this edge in forever. It was like 30 cents under my value. I would have
Okay.
bought 30. Maybe I would have gotten crazy if it was tomorrow when this happened or Thursday when I could finally start trading. I would have bought 100 of them, and
Right.
that's like for me that's a $3,500 trade. You hedge them. We went back up or we kind of oscillated around, but market maker. See, I would just keep that inventory. It's hedged, and now I'm going to sell other things against it. So
Right.
what I'm trying to deal, I'm hedging volatility. I'm not hedging delta anymore. So that's what market makers do. They'll take those orders where I mean, that guy should have just sold the bid, whatever. Like it's like you
Right.
sticking out an order trying to get out of your shit. And
Right.
I'm like, oh my God, there's 30 cents of edge, and I buy your puts, and I buy some stock, and I wait, and I be patient.
Right.
That's the market makers are patient, man. That's
Right.
basically what we're getting at.
Right.
I warehouse the inventory as long
Right.
as it doesn't take like the whole day and I lose decay on it. I'm gonna get out for edge as well. And some guy came in 40 minutes later. He was bidding like at theoretical value, maybe a little higher, and I would have sold 50, and I would have been out and done for the day. It was like a $2,000 trade just on one strike, on
Jeez.
one instance. You know what I'm saying? So it's like for me, you do that. I mean, that's an exceptional case, but you do that as many times as possible. You're making
Right.
good money.
Right. All right, man. All right, so you heard it here from Mr. Weiner. We're gonna have a lot more talks here on his, approach to market making, using his theoretical values and all that kind of stuff. So we're really gonna bring his strategy to light as well. Obviously, not too much of the secret sauce here because that is his game. That is the man. That's what the man does. Dude, Brian, let's get back together next Tuesday, man.
No doubt.
And then don't get swept away by the storm, baby.
No doubt. Good luck, baby.
All right, man.
Later.